Ladies and gentlemen, boys and girls, economic thrill seekers and recession-weary warriors, welcome back to Boss Economics World. The show where we peel back the glittering facade of government spin, corporate jargon, and central bank fairy tales to reveal the cold, hard, and often absurd truth about the economy. I'm your host, the one, the only, the Boss Economist, here to save your wallets, your sanity, and maybe even your faith in humanity. Buckle up, because today, we're diving headfirst into a golden mess, literally, and exposing how the powers that be are fumbling the ball so badly, they're practically begging for a recession double dip. Let's get into it. So, let's talk about the shiny stuff, gold. That precious metal your grandma hoards in her attic, your uncle buys in bars from shady infomercials, and central banks cling to like a life raft in a sea of their own bad decisions. According to a fresh report from Citigroup, yes, the same folks who helped us navigate the 2008 financial crisis with all the grace of a drunk tightrope walker, gold is about to take a nosedive. They're calling it, gold will slump back to $2,500 to $2,700 an ounce by the second half of 2026, down from its current perch near $3,393. And folks, this isn't just a market hiccup, it's a neon sign flashing economic chaos ahead. So, what's driving this golden meltdown, and why should you care? Let's break it down, layer by layer, from the surface glitter to the deep, dark economic muck beneath. First, let's talk about gold's blockbuster year. In 2025, gold prices soared by a whopping 30%, hitting record highs in April. Why? Because the world was a hot mess, and gold loves chaos like a reality TV star loves drama. US President Donald Trump's trade policies, think tariffs on steroids, sent shockwaves through global markets, while the Middle East crisis, particularly the Israel-Iran conflict, had investors running for safe havens faster than you can say, geopolitical dumpster fire. Add to that central banks stockpiling gold to diversify their reserves, because apparently, they don't trust their own fiat currencies, and you've got a recipe for a gold rush. But now, Citi's analysts are saying the party's over. Why? 3 big reasons: weaker investment demand, improving global growth prospects, and, brace yourself, the Federal Reserve's rate cuts. Sounds reasonable, right? Wrong. This is where the surface-level story starts to crack, revealing the government's fingerprints all over this economic crime scene. Let's dig deeper. Let's start with the Federal Reserve, because if there's one institution that loves to play economic Jenga with your future, it's them. Citi's analysts are practically salivating over the Fed's plan to cut rates from restrictive to neutral. Translation: after hiking rates to fight inflation, causing mortgage rates to skyrocket, small businesses to collapse, and your grocery bill to look like a car payment, the Fed is now ready to ease up. Sounds great, right? Lower rates mean cheaper borrowing, more investment, and a boost to growth, which could calm markets and reduce demand for gold as a safe haven. But hold on a second. Neutral policy? In this economy? Let's look at the data. As of mid-2025, the Fed's benchmark rate is still hovering around 4.5%, down from a peak of 5.5% in 2023, but still high by historical standards. Meanwhile, inflation is stubbornly stuck at 3.8%, well above the Fed's 2% target, according to the Bureau of Labor Statistics. And don't even get me started on unemployment, officially at 4.2%, but if you include discouraged workers and the underemployed, the real rate is closer to 8%, per the U6 measure from the BLS. So, the Fed thinks slashing rates now will magically fix all this? Ha! It's like putting a band-aid on a broken leg and calling it surgery. Here's the kicker: rate cuts in an already fragile economy risk reigniting inflation, especially with Trump's stimulatory budget pumping money into the system like a sugar-high toddler with a fire hose. Just look at the numbers. The Congressional Budget Office projects the U.S. federal deficit will hit $2.1 trillion in 2025, up from $1.6 trillion in 2024, thanks to tax cuts and increased spending. That's a 31% jump in borrowing. And what happens when you flood an economy with cheap money while prices are already rising? You get stagflation, a toxic mix of stagnant growth and runaway inflation. Remember the 1970s? Yeah, it wasn't pretty. Gold thrived back then, but if the Fed's cuts are too timid or too late, investors might ditch gold for riskier assets, tanking its price. Thanks, Fed, for playing Russian roulette with our economy, again. Now, let's talk about the elephant in the room, or should I say, the golden-haired dealmaker in the White House. Donald Trump's trade policies have been a roller coaster of chaos, and they're a big reason gold soared in the first place. His latest tariff threats, 25% on Chinese goods, 10% on European imports, sent global markets into a tailspin, driving investors to gold as a safe haven. But here's where it gets juicy. Citi's analysts are betting that Trump's policies will become less bearish, meaning he'll either back off the tariffs or strike quick deals to resolve trade tensions. If that happens, global growth confidence could improve, reducing demand for gold and sending prices plummeting. But let's not kid ourselves, Trump isn't exactly known for de-escalation. Just look at what happened on June 17, 2025, gold prices whipsawed after Trump called for an evacuation of Tehran amid the Israel-Iran conflict, then stormed out of a G7 summit early, tweeting, "I don't negotiate with weak leaders." The result? Markets panicked, gold spiked, and the S&P 500 dropped 2% in a single day. And this is the guy Citi thinks will calm things down? Please. Here's the real problem: Trump's tariffs aren't just a negotiating tactic, they're a wrecking ball to global supply chains. The Peterson Institute for International Economics estimates that Trump's tariffs could shave 0.5% off global GDP by the end of 2026 if they persist. That's $500 billion in lost economic output. And who pays the price? You do. Higher tariffs mean higher prices for everything from iPhones to washing machines, adding an estimated $1,300 per year to the average American household's expenses, per the National Bureau of Economic Research. So, while Citi dreams of a tariff resolution, the reality is more chaos, more uncertainty, and more economic pain. And guess what? That pain could either keep gold aloft, or crash it if investors lose faith entirely. Speaking of chaos, let's not forget the Middle East. The Israel-Iran conflict is escalating faster than a reality TV feud, with Trump's evacuation call for Tehran sending oil prices, and gold prices, through the roof. Brent crude is now trading at $95 a barrel, up 20% since January 2025, per Bloomberg data. Why does this matter for gold? Because geopolitical instability is gold's best friend. When missiles fly, investors flee to safe havens, and gold shines. But here's the twist: Citi's analysts are betting on a modest improvement in global growth confidence, which could dampen gold demand. Really? With Iran threatening to close the Strait of Hormuz, through which 20% of the world's oil flows, and Israel conducting airstrikes, you think confidence is going to improve? The International Energy Agency warns that a prolonged conflict could push oil prices past $120 a barrel, triggering a global energy crisis. And let's not forget the human cost. The UN estimates 1.2 million people have been displaced in the region since January 2025. This isn't just an economic story, it's a humanitarian tragedy, and one that could keep gold elevated if tensions persist. Citi's optimism here is either delusional or downright cynical. Finally, let's zoom out to the big picture: the US government's fiscal irresponsibility. Gold's rally wasn't just about tariffs or geopolitics, it was about investors losing faith in the US dollar as a store of value. Why? Because the US deficit is ballooning like a bad reality TV budget. As I mentioned earlier, the CBO projects a $2.1 trillion deficit in 2025, a level unseen outside of major crises like the 2008 crash or the COVID-19 pandemic. And for what? Tax cuts for billionaires, military spending, and pork barrel projects that do nothing for the average American. Here's the scary part: the US debt to GDP ratio is now at 125%, according to the IMF, the highest since World War II. And with interest rates still elevated, the cost of servicing that debt is skyrocketing. The Treasury Department estimates that interest payments will hit $1 trillion annually by 2026, more than we spend on Medicare or defense. This is why central banks are hoarding gold. They don't trust the dollar, and neither should you. But if the Fed cuts rates and global growth picks up, investors might ditch gold for stocks or crypto, sending prices crashing. It's a high-stakes gamble, and the government's reckless spending is the house of cards it's built on. So, what does all this mean? Let's connect the dots. Gold's potential slump isn't just a commodity story, it's a symptom of deeper economic dysfunction. The Fed's rate cuts risk reigniting inflation, Trump's trade wars threaten global growth, the Middle East crisis could spiral into a full-blown energy shock, and the government's deficit spending is a ticking time bomb. And who's steering the ship? A government more interested in political theater than economic stability. Here's my hot take: Citi's prediction of gold falling to $2,500, $2,700 by 2026 is plausible, but it hinges on a fantasy of government competence and global stability that simply doesn't exist. The more likely scenario: stagflation, geopolitical chaos, and a dollar crisis keep gold elevated, or even push it higher, before a catastrophic policy misstep sends the entire economy, and gold, into a tailspin. Either way, the real losers are you, me, and every hardworking person trying to survive this economic circus. So, what's the play, folks? For the average viewer, diversify your portfolio, don't bet the farm on gold, but don't ignore it either. For finance pros, keep an eye on the Fed's moves, Trump's tweets, and oil prices, they'll be the canaries in the coal mine. And for everyone, demand better from your leaders. Call out the mismanagement, the short-sighted policies, and the reckless spending. Because if we don't, the next recession won't just be a dip, it'll be a disaster. That's all for today, folks. Remember, in a world of economic insanity, knowledge is your superpower. Like, subscribe, and ring that bell to join the Boss Economics world revolution. Until next time, keep fighting the good fight, and watch your wallets. Peace out.